let's talk a little bit about basic economic fundamentals. Now, this is important because stock prices are based on expectations for future economic growth. Now, right now, the expectation is we're going to see spending going up a lot. We're going to see people moving around more than they have, obviously, in the past year. And that's going to lead to strong growth in corporate earnings. All of that leads to expectations of an economy that is probably going to be one of the fastest growing that we've ever experienced in our lifetimes. Now, unfortunately, that also leads to some other things that cannot be avoided when you have that fast a growth in the economy. We're going to see things like gas prices going up. We've already seen housing going up a lot, which is causing some issues we're not going to talk about today. And then we've seen goods and services already starting to go up in prices because with more people spending money, higher demand, that leads to the ability to raise prices. We also are probably going to see wages going up. Now, all of those things leads to an ugly word called inflation. And so what we're seeing happening in the bond market is the bond market hates inflation. It makes things more expensive for everybody to pay for, and it actually devalues the price of the bond if you already hold it. So we've seen interest rates going up a lot to take into effect what could be an inflationary environment. Now, let's take a step back and look at what's causing these strong growth expectations. Essentially, we're seeing, who knows, $2 trillion for sure is coming down the road, on top of the 5 or 6 trillion that was already spent in 2020. There's talk of a $2 to $3 trillion infrastructure spending plan. Basically, we're seeing money just dropped on the economy trying to get things going. But at the same time, that's all leading to an increase in debt, which with the increase in interest rates means our interest expenses are going to go up. And so that's causing people to wonder maybe the US won't be able to continue borrowing at historically low interest rates, which could lead to the inability to drop as much money onto the economy. Now, we have to keep in mind the Federal Reserve does not control the long end of the yield curve. They can set short-term rates. They've been working with 2 years and less on the yield curve to try to control those rates and keep them low. The free market controls the long end, and we're seeing the free market say, hey, we need to get paid more if you're going to borrow this much money, if we're going to see inflation. So what that can do ultimately is if you look at things, consider when gas prices go up and prices of goods and services go up and housing goes up, that hurts people on the lower part of what we've been calling the K-shaped economy. Those people who suffered the most during COVID, those people living paycheck to paycheck. When you add in higher interest expenses for things, that'll cause, credit card debt to, interest rates to go up, auto loan prices to go up, housing loans to go up. It makes things not very affordable, which will then squash spending. People will move around less, and we'll see corporate earnings fall. At the same time, I fully expect then prices will start to fall. We have to keep in mind this has nothing to do with who is president, who controls Congress, who's in charge of the Federal Reserve. When there's high demand, prices go up. When there's lower demand, prices go down, and I fully expect that to happen. The question is, where do we find that equilibrium? The problem is the stock market has a historically high valuation point. People are expecting a rocket ship. If we don't get that, prices need to be reset. So the danger is, as interest rates go up, stock prices could get hurt a lot. And we've seen that recently. It could continue. Now at SEM, we're going to follow the trends. We are definitely concerned about what's been happening. And if things continue to get worse in the stock market, we will definitely see our models start to take action. That's the key when you work with SEM is we don't have to guess about what's going to happen. We don't have to base our expectations on what Congress does or the Federal Reserve does. We just follow the money and we act accordingly. So I'm past my time today. Please stay tuned for future videos. It's already shaping up to be an interesting year. Talk to you soon.